Debt was once a sin, now it's the most profitable business on earth. How did lending money become more powerful than gold, oil, or even tech? It began in medieval Europe, when lending money was considered immoral and even illegal. Yet over time, necessity and innovation reshaped society's view. From the rise of promissory notes to the birth of banks, every new financial tool turned debt into something bigger, more sophisticated, and far more profitable. Today, it doesn't just fuel economies, it defines them. The early church held a strong stance against usury, viewing it as morally reprehensible. Usury was defined as lending money with the expectation of receiving interest. This prohibition stemmed from religious and ethical considerations prevalent at the time. Monks and theologians debated the morality of profiting from loans, emphasizing principles of fairness and charity. Merchant banking emerged from the need to finance increasingly complex trade expeditions. Merchants began pooling their resources to fund these ventures collectively. This pooling of resources marked the beginning of more organized lending activities. These activities were conducted on a larger scale than individual merchants could previously manage. This collaborative approach laid the foundation for modern merchant banking practices. Royal borrowing involves monarchs obtaining funds from wealthy merchants or entities. These funds are typically used to finance wars, infrastructure, or other state projects. This practice establishes the concept of sovereign debt, where the state owes money. Sovereign debt forms the basis of a nation's financial obligations and creditworthiness. Banking has evolved from basic money lending practices. Early banking focused on providing loans to individuals and businesses. Over time, banking expanded to include currency exchange services. Currency exchange facilitated international trade and commerce. Deposit taking became a core function, allowing banks to manage and invest funds. Bills of exchange emerged as a trade facilitation tool in the medieval period. Merchants used them to conduct transactions across different regions. These bills reduced the need to transport physical currency over long distances. Bills of exchange also enabled the extension of credit between merchants. This system fostered trade by providing a more secure and efficient payment method. Gothic cathedrals were massive undertakings requiring significant financial resources. Debt financing played a crucial role in funding these large-scale construction projects. Lending enabled communities to initiate and sustain cathedral construction over extended periods. Borrowing allowed for the accumulation of necessary materials and skilled labor. The use of debt demonstrates the ambition and long-term vision associated with cathedral building. Scholarly debates are crucial for developing economic theories related to money. These discussions also contribute to understanding the dynamics of interest rates. Theories about debt and its impact on economies are also explored. These intellectual explorations form the foundation of modern finance. Debt can significantly worsen the suffering of vulnerable populations during crises. Economic hardships can lead to an inability to repay debts. This inability often results in foreclosures, where assets are seized to cover outstanding debts. Foreclosures and widespread debt can lead to social unrest and instability within communities. Compound interest allows debts to grow exponentially over time. It benefits lenders by increasing the amount owed on a principal sum. The initial debt, or principal, is the starting point. Interest is calculated not only on the principal, but also on the accumulated interest from previous periods. This creates a snowball effect, where the debt grows at an accelerating rate. Therefore, even small debts can become substantial due to the effects of compounding. Lending practices played a crucial role in the expansion of trade routes during the medieval period. Merchants and traders often relied on loans to finance their voyages and commercial activities. Access to capital through debt enabled traders to invest in larger quantities of goods for trade. This facilitated the growth of international commerce by enabling long-distance trade. The increased trade volume spurred economic development in various regions. Therefore, debt acted as a catalyst for trade expansion and economic progress in medieval times. Early financial speculation involved individuals experimenting with new forms of investment. These early markets presented opportunities for substantial profit. However, these investments also carried a significant risk of loss. The alchemist's workshop symbolizes the experimental and uncertain nature of these ventures. These activities laid the groundwork for modern financial markets and risk management. Governments historically utilized taxation as a primary mechanism for debt repayment. Taxes collected from citizens and businesses are directed towards fulfilling financial obligations to lenders. This process establishes a direct link between public finance and the repayment of sovereign debt. Effective tax collection is crucial for maintaining a nation's creditworthiness and access to future loans. Debt repayment through taxation ensures the stability of public finances and investor confidence. The system connects private wealth, generated by citizens and businesses, to the financial health of the government. The printing press revolutionized the spread of financial and economic knowledge. Before its invention, access to financial information was limited and costly. The printing press enabled mass production of books and pamphlets on finance. This led to a significant decrease in the cost of financial education materials. Wider availability of information increased financial literacy among the population. Consequently, more people could make informed financial decisions, fostering economic growth. Debt financing played a crucial role in funding naval expeditions during the Age of Exploration. European powers used debt to equip ships, hire crews, and procure supplies for long voyages. These expeditions facilitated exploration, colonization, and expansion of European influence. The financial risks were high, but the potential rewards of new trade routes and resources justified the investment. Contract law developed to enforce debt contracts and protect lenders' rights. This development was crucial for establishing a legal framework for finance. Early legal systems recognized the need to ensure repayment of debts. Enforcement mechanisms were created to hold borrowers accountable. These mechanisms provided security for lenders, encouraging investment. The evolution of contract law solidified the legal basis for financial transactions. Artisans can utilize debt to fuel the expansion of their businesses. Loans enable artisans to invest in better tools and equipment. This investment leads to improved production methods and increased efficiency. Ultimately, strategic debt usage drives innovation and economic growth within the artisan sector. Excessive debt can trigger widespread social unrest and instability. Unfair lending practices often exacerbate the burden on vulnerable populations. Peasant revolts are a historical consequence of unsustainable debt levels. These revolts often target lenders and systems perceived as unjust. Social instability arises from the desperation and grievances of indebted communities. Debt relief and fair lending policies are crucial for maintaining social order. National debt management involves strategies governments use to handle their accumulated debts. Governments employ various financial instruments, such as bonds and treasury bills, to finance and refinance debt. Effective debt management aims to maintain solvency, ensuring the government can meet its financial obligations. Maintaining creditworthiness is crucial for favorable borrowing terms and investor confidence. Debt management policies include strategies for restructuring debt to reduce interest payments or extend repayment periods. Sound fiscal policies and transparent reporting are essential components of responsible national debt management. Formal economic theories began to emerge during the medieval period. These theories aimed to provide a justification for the role of debt in society. They sought to explain the economic functions and implications of debt. This formalization helped to shape societal understanding and acceptance of debt. Medieval universities played a key role in developing and disseminating these economic theories. Debt facilitates the purchase of goods and services. Increased purchasing stimulates economic activity. This stimulation leads to increased production and trade. The expansion requires further investment, often through borrowing. This borrowing fuels more spending, continuing the cycle. The cycle of borrowing and spending becomes self-reinforcing. Bankers accumulate wealth by lending money, a fundamental aspect of financial systems. Interest collected on these loans is a primary source of income for bankers. The consistent repayment of loans with interest allows for continuous capital growth. This accumulation of capital enables bankers to extend larger and more numerous loans. As their financial influence grows, bankers often become powerful figures in society. Their control over capital provides them with significant economic and political leverage. Warfare often incurs substantial financial costs for participating nations. These costs frequently necessitate extensive borrowing and the accumulation of national debt. The economic consequences of war can extend far beyond the immediate conflict. Long-term financial burdens can hinder economic growth and development. Post-war recovery efforts require significant financial investment. The financial strain of war can impact social programs and public services. Public announcements were a primary method for disseminating financial information. Town criers played a crucial role in communicating updates on interest rates. They also announced available loan opportunities to the public. Financial regulations and policies were conveyed through these public declarations. Debt has become an integral aspect of modern economic life. It influences various sectors, from personal finance to global markets. Debt can stimulate economic growth by enabling investment and consumption. However, excessive debt can also lead to financial instability and crises. The management and impact of debt are critical considerations for individuals and societies.